Welcome to the deep dive. Our mission, as always, is to cut through the noise and get straight to the insights you can actually use.
And today, we are tackling a really profound financial transformation.
We're doing a deep dive into the massive shift in Vietnamese financial reporting, specifically the move away from their long-standing domestic standard and toward, well, global alignment with IFRS.
This is so much more than just a bureaucratic change. It's really about changing the DNA of how business health is reported in Vietnam.
So we're looking at the mandatory move from the Vietnamese Accounting Standards, or VAS, to the International Financial Reporting Standards.
And our mission today is to unpack the huge structural differences between them and, maybe more importantly, get into the weeds on the operational challenges, the nitty-gritty of compliance.
Exactly, because most companies right now are on VAS, which is very rules-based and tied directly to local tax law, but that whole system is being turned on its head.
It really is.
Okay, so let's start with that foundational divide, VAS versus IFRS. What is the core philosophical clash here?
It really just boils down to mindset. VAS is fundamentally rules-based. It's like a checklist. If this happens, you must do exactly this. There's a very little room for, professional judgment.
And IFRS is the opposite.
Completely. IFRS is principles-based. It tells you the goal the financials have to show the true economic substance, and then it expects accountants to use their judgment to achieve that goal.
That sounds like a subtle difference, but I imagine it has massive real-world impacts, especially for anyone trying to read a balance sheet.
Oh, huge impacts. The most obvious place you see it is in asset valuation.
Okay.
So with VAS, the foundation is almost always historical cost. You buy a machine, you record it at its purchase price, and that's pretty much it. Besides depreciation, the value is static, reflects the past.
And IFRS, I take it, doesn't really trust that history.
Not at all. IFRS is all about fair value. For a lot of assets, you have to constantly revalue them to reflect what they're actually worth in the market today.
Which gives investors a much clearer picture, I suppose.
A clearer, but also much more volatile picture. That's a key difference. VAS avoids that volatility.
Right. And this leads to some really shocking differences in how wealthy a company appears on paper. Let's take an example from our sources, asset impairment.
Yes.
So say you own a factory full of PPE property, plant, and equipment, and some new invention makes all your machinery obsolete overnight. What happens under VAS?
Well, historically under VAS, you generally weren't required to recognize an impairment loss on those assets.
So even if the economic value just fell off a cliff,
VAS would often let you just keep it on the balance sheet at that higher historical cost. So you get these potentially inflated asset values that don't match economic reality at all.
that feels dangerous for anyone relying on those reports.
It is. It's why reconciliation is such a big deal. Because IFRS mandates the exact opposite. Impairment testing is compulsory, annually.
And if the value is lower?
You have to take a write-down immediately. It's a huge hit to the income statement that the local standard just let companies, sidestep.
And we see the flip side of that with goodwill, right? The premium you pay when you buy another company.
Exactly. Under VAS, goodwill is something to be managed. So it's amortized. You spread that cost out over, say, up to 10 years. It keeps the expense line smooth and predictable.
And IFRS doesn't do smooth and predictable.
No. IFRS says you do not amortize goodwill. It just sits there on the balance sheet. But this is the key. It has to go through a mandatory annual impairment review.
So if the company you bought isn't performing,
you take a massive one-time write-down. It can wipe out a year's profit in a single entry. It's brutal, but it's arguably more honest.
Okay, and the last big one, leases. IFRS 16. This is a game changer for any business that rents, well, anything.
A total game changer. VAS had a clear split. Finance leases on the balance sheet, but operating leases were kept off. You just expense them like rent.
Which made companies look like they had fewer liabilities.
Of course.
Yeah.
But IFRS 16 brought in the single model. It basically got rid of that distinction. Now, almost every single lease has to be put on the balance sheet.
As what?
As a right-of-use asset on one side and a lease liability on the other. It completely transforms the balance sheet for retailers, logistics companies, anyone who leases heavily.
So if you're a multinational in, say, Ho Chi Minh City, you're living in two worlds, reporting under VAS locally, and then doing all these costly, complicated adjustments to report up to your parent company under IFRS. It's double the work.
It is. And that lack of transparency and comparability is what finally pushed the government to act. They knew they had to align to keep attracting investment.
Okay, so let's talk about the plan to fix that. Vietnam created a phased IFRS adoption roadmap. Phase 1, the voluntary application, started back in 2022.
Right. And that runs until 2025. This was a really strategic move. It targeted the biggest players, state-owned enterprises, listed companies, big foreign-invested
A
firms.
pilot program, basically.
Exactly. Give them the option to use IFRS or their consolidated statements and see how it goes with the organizations that have the most resources.
And then, after 2025, the plan is for compulsory application for certain groups. But they couldn't just force pure IFRS on every small local shop, could they?
No, that would have been a disaster for SMEs, so they created a compromise.
Which is the Vietnamese Financial Reporting Standards, or VFRS?
That's the key. VFRS is the new standard that will replace the old VAS for the vast majority of local, non-public companies.
So is it just IFRS Lite, a sort of watered-down version?
I call it a genuine adaptation. It's built on IFRS principles, but it has what they call narrow scope modifications. Meaning tweaks and exceptions to fit Vietnam's specific legal system, its economic conditions, and this is the big one. It's very specific tax rules. It's IFRS principles, but adapted for Vietnamese reality.
So VFRS is the official signal of that philosophical shift we talked about, from rules-based to principles-based. And the go-live date for all of this is January 1st, 2026.
That's the plan. That's the high-level view. But when you get down to the operational level, to how a finance clerk actually books an invoice, that's where you slam into the wall of rigidity that still defines the system.
You're talking about the Mandatory Vietnamese Chart of Accounts, the VCOA.
Yes. Our sources really hammer this point. This is the heart of compliance, dictated by the Ministry of Finance under Circular 200 or 133.
And what makes it so challenging compared to how a multinational might set up their own COA?
Well, most global companies see their chart of accounts as a flexible internal tool. You design it for your own reporting needs.
But not in Vietnam.
In Vietnam, the COA is a regulatory mandate. The government tells you the specific account numbers for Level 1 and Level 2 and their exact names in Vietnamese. You can't just use your own structure from your global SAP system.
So you have to map your company's accounts to the closest Vietnamese equivalent, and you have to use their official numbers.
You have to. It's mandatory. The only flexibility you get is adding sub-accounts. So, for example, the official account for trade receivables is 131. But you can create your own sub-accounts, like 1311 for domestic customers and 1312 for foreign customers. You obey their top-level structure, but add your detail underneath.
This rigidity is a perfect setup for what might be the most counterintuitive requirement we found. Account 910.
Ah, yes. The determination of business results account.
To anyone used to modern accounting software, this seems totally bizarre. Explain what this account actually does.
Its purpose is purely regulatory. It's not functional. I mean, look, any modern ERP system can calculate your net profit dynamically. It just sums up your revenues and subtracts your expenses. It doesn't need a special temporary account.
But the VFRS rules say you have to have one.
You must use it. Account 91 Day is mandated as a temporary control account for your year-end closing process.
So it's like a mandatory funnel for the audit trail.
That is the perfect way to describe it. At UN, the system has to go through a process where it zeroes out every single revenue and expense account, your 500, 600, 700s, 800s, by posting all their balances into account 9110.
A required administrative step.
It's a non-negotiable checkpoint. It proves to the auditors that all your temporary income statement accounts were properly closed out.
And once that 9110 funnel has the final net profit or loss, where does it go?
From there, the final balance is transferred to the balance sheet, specifically to account 4191, which is your undistributed profit or retained earnings.
And if your system setup skips that step,
your books are non-compliant, period. It doesn't matter if the final profit number is correct. You fail the process.
which just highlights how critical that initial system setup is. Getting the core control accounts right from day one, debtors, creditors, retained earnings.
And manually adding the inventory control account if you carry stock. If you miss those, the whole mandated closing process just breaks down. It's a case of regulation dictating the technology, not the other way around.
Let's shift to the other big localization challenge, tax. Specifically Vietnamese VAT. What do businesses need to track?
Okay, so you've got three main rates, plus a temporary one that adds a layer of complexity.
What are the main ones?
You have the 10% standard rate, which covers most things, then a 5% reduced rate on essentials like medicine, and finally a 0% export rate for, well, exports.
And the complication.
The complication is the 8% temporary reduced rate. This is a government resolution, not a permanent law. It applies to goods and services that would normally be 10%, but it excludes specific industries like finance and real estate.
Which sounds like a nightmare for system configuration.
It is. Your system has to be able to handle this temporary rate separately, which means setting up specific sub-accounts for, say, 8% input VAT. It's incredibly granular.
And all this is tracked in specific control accounts, right? Mandated by Circular 200.
Correct. You have account 133, which is your deductible input VAT. That's an asset. And you have account 3331, which is your output VAT payable. That's a liability.
And the tax return is just netting those two out.
That's all it is. At the end of the period, you compare the two. If you owe more than you can deduct, you pay the difference. If you have more deductions, you carry that credit forward.
This level of detail really shows how critical perfect translation and localization are.
Absolutely.
And there was a fantastic, almost comical example in the source material about what happens when translation goes wrong. It was about the term credit note.
Oh, this is a classic. It's the kind of mistake that causes complete operational chaos. So a credit note, which means a customer owes you less money,
Right.
was repeatedly translated into the system as figino.
And what does figina mean?
It means debit note.
Wait, so they were telling the system to increase what the customer owed when they meant to decrease it.
Precisely. They inverted the entire accounting entry. The word na means debit, and co means credit. By using the wrong term, they were completely confusing the fundamental direction of the transaction. Think about the mess that creates.
The cleanup, the audit risk, all from one bad translation.
It's a perfect reminder that localization isn't just about changing the language on the screen. It's about deep financial definitions.
And even navigating that screen requires knowing all the standard abbreviations.
For sure. You have to know that HATE's an invoice, NCC is a supplier, MST is a tax ID, and even something technical like a bill of materials gets shortened to AMNL. Everything is standardized.
Okay, let's pull all of this together. We've covered a lot of ground. We started with the big picture, the philosophical move from rigid, rules-based VAS to the principles-based VFRS.
Which is that bridge to IFRS alignment, expected to be mandatory for most companies by 2026.
But then we saw how that philosophical shift collides with some very hard operational realities.
The mandatory, non-negotiable Vietnamese chart of accounts, with all its quirks, like the account 91-1 closing mechanism.
And finally, the need for absolute precision and localization, getting the tax mapping right, down to that temporary 8% VAT rate, and of course, not mixing up your debits and credits. So what's the final takeaway for someone navigating this complex environment?
I think what we're seeing is this incredible tension playing out in real time. On one hand, the FRS is a huge step forward. It moves Vietnam toward global principles like using fair value. That's good for everyone. But the continued rigidity of things like the mandatory chart of accounts and the need to embed very specific temporary tax rules directly into the accounting system shows that domestic law and tax policy still have immense power.
They can override pure accounting theory.
They absolutely can. They dictate the exact shape of the standards, even when it's not the most efficient way to report the economics. So I guess the final thought is for you to reflect on your own regulatory environment. How many rules are in your accounting system, not because they reflect economic reality, but simply because the local tax authority demands it?
A fascinating look at where global principles meet local power. That is definitely something to think about.